Hello, my name is Adam Dow. I'm with the Dow Group in New Hampshire. We are a real estate team covering the entire state. You may have just watched our video on 1031 exchanges. If you haven't, check it out. In the 1031 exchange conversation is something that's called the DST. So I've got another guest with me. Why don't you introduce yourself? Tell us, what does DST stand for and a quick snapshot of what a DST is.
Sure. Thanks, Adam. My name's Heather Ahrens. I'm from Four Springs Capital Markets. What a DST simply is a tax structure. It's short for Delaware Statutory Trusts. It allows a DST sponsor, which is a company that buys the properties, the ability to put a property in that tax structure to take fractional ownership from 1031 investors.
So we're doing a 1031 right now, which is how we met. And
Right.
we had a little bit of an extra, or we may have a little bit extra, we haven't sold it yet, money left over. So in a 1031, if you watch the 1031 video, it's a like-kind exchange, but it's also equal to or greater in value. And we were going to take that, and it's going to be part of our 1031 exchange, and we're going to be giving that money, or actually the intermediary is going to be giving that money to you to fulfill the rest of the exchange.
Right.
And so what we're actually investing in is a real project, right?
Yes. So what a DST is, a DST sponsor will go out and buy the real estate, engage in a long-term contract. Ours are specifically medical and industrial, and they have to meet a certain criteria for our DSTs. They have to be institutional quality, typically investment grade properties. We don't buy anything that are mom and pops or franchises. They're typically long-term single tenant net lease corporate leases. The likes of Amazon or Ford, like household names of that caliber.
Because the risk of a DST or any sort of investment is the project you're investing in goes belly out. So not only are you looking at, is a DST a good avenue for my money, you're looking as a consumer, looking for the right DST company. And what you guys look for is the right companies to invest in, the right projects to invest in. So what's the advantages of a DST, and maybe what are a couple of the downfalls?
Yeah, the advantages, there are a lot of them. The fact that they qualify as real estate because you own a piece of the building, so that's why it does qualify. But it's truly passive income. Properties that we buy are usually triple net leases. If they're double net, then it's a brand new building and the roof is brand new and it's covered. It's a 30-year warranty. But on the triple net, so there's no responsibilities on the investor. It's all on the tenant. So and because we've signed a long-term lease, typically minimally 10 years or longer, the investor knows the cash flow that's going to come in, and we have the predictability of the duration of that income coming. Our programs typically last 5 to 7 years, and then we'll sell that underlying asset, and then a client can decide whether they would like to do another 1031 into another like-kind exchange. It doesn't actually have to be another DST, but when we do sell a DST, we will always have another DST that will match up so that they can invest in something else, so they have the ability not to have to pay tax on that.
And we were just talking with the team about, both of these, the 1031 and the DST. Perhaps people are out there and they have this investment property and they don't want to go through the hassle of finding another property that's like kind. They don't want to have, ownership of another property that they may have to manage and things like that. So I would think that's where it's a great application of the DST.
Yeah, it's utilized in a couple of different capacities. A lot of it is like if your investor's on the back nine of their career, they really don't want to be actively managing it, then they might sell the property that they have been getting income in and then put all the funds into a DST. Or in like your instance, like say you're selling something, you're planning on buying another hard asset, but you've got this leftover money and you can't find another property that fits your criteria. You could put most DSTs have a minimum of 100,000. We are able to waive that, but you are able to put 100,000 all the way up to, if the building's 100 million, the entire amount, and have passive income. And it's professionally managed by our teams that takes care of doing everything.
Your company's been around for a while.
We've been in business since 2008. We've purchased over $2 billion of real estate. Yep. We have two different divisions. We've got a DST division, and then we have a real estate investment trust, also known as a REIT, which is basically just a portfolio or like a mutual fund of the same type of institutional investment grade properties. When our acquisition team is looking for properties, it doesn't matter whether we're going to put it into that DST structure. We're either going to buy it for our DST or our REIT because it's the same high quality criteria that we have to buy in.
You want to have minimal risk,
right,
good return, not a lot of oversight.
Right.
Things like that. So in the DST world, I'm assuming not all DST companies are created equal.
They are not. And then it also is subject to what's on the market at that time. We just did one that was a Tesla in Londonderry, New Hampshire. That was 22 million. But then we're launching one. We have another one that's 90 some odd million. And so once that DST is filled, we'll close it and go on to the next project.
Got it.
So it's key to make sure that the investor has spoken to either myself or Michelle, and we're preparing for trying to close on this property so that I can reserve what they need, so that if an investor sold something for say $3 million and they've got another property they want to buy for 2.5, they might use the DST for that $500,000 that they would have to pay the 30-40% on, or what they can do is use a DST as a backup for that whole $2.5 million just in case during their due diligence period, and after their 45th day they uncover something about the property that they don't like, they'll have something that's already ready and they can defer all the tax.
I would think it's just best practice to have, if you have properties identified, include a DST. You
Right.
only have 3, especially if you've got one that, all right, like for us, we've got one identified, we've got it under contract. If that doesn't go, we don't want to scramble and find something else.
Right.
Most likely, we want to, we'd probably just do a DST and
Right.
close on it. We talked about too, an interesting application is, somebody who's held land for a long time and they've got this investment that's matured and it's been a good investment for them, but it's just kind of sitting there. Maybe the DST is a good avenue for land.
Yeah, it's an excellent fit because they're not receiving income off that land. And if it's appreciated, they don't want to pay the tax on it. And if they roll it into a DST, they still have no management because a DST is truly passive income. They'll collect the monthly income. And the distributions range. Our properties are very high quality, so it's roughly around 5%. It can be a little bit more, but just that's what I would consider. And they get that on a monthly basis. So the investors, they love it because they had an asset that wasn't producing any income and they're going into something that's still, they're not having any headaches or any management, and they're able to collect a nice income that gets paid monthly.
Yeah, I'm obviously very pro real estate investment,
Right.
and real estate appreciation over time.
Right.
And I think a lot of people that hold land have that same value, but this is a way for you to take the same principles and apply it into a very knowledgeable company, investing in other companies that have a track record of being successful in this triple net lease atmosphere, and to actually get a return.
Yeah, they'll get the return based on the cash flow that the tenant's paying. And at the end of the program, if we sell the property, they own a certain percentage of that property. If there is capital appreciation, they participate in that as well. We're doing this because it's high quality and the risk is low, really to preserve the principal and not have to have them pay 30 to 40%. But in every one of our private placement memorandums that we send out, it will show our past performance. And typically, most investments, they get their principal back and then another 7 to 11%. That's not guaranteed, but just that's typically what we do.
And they can roll that into another.
They roll that into another DST because once you go into it and you really have truly passive income, they love it. Yeah. And they're like, I don't really want to deal with the maintenance and then the unexpected costs of managing a building, whether it's a new roof or the capital expenditure, or even seepage when you've got, if you have a multifamily and there's apartments that aren't renting. So, that diminishes your return as well.
So it sounds like you're an under promise, over deliver.
Right.
And a lot of these, you say, all right, let's look at the 5%. Does it make sense? If it's what you're selling, does that make sense? And then there could be upside, but it's just,
right.
This is what we do. We do it well. We're hoping to come back with some good results, but let's make decisions on these numbers.
Yeah, and the risks to DSTs, and that they should be pointed out, is the lack of liquidity. So you're in that program for 5 to 7 years. So say in 3 years, you're like, oh, I found a great property. I would like to, get myself out. You can't. There's not a third party. There is a company that does it, but it's not worth it because you end up paying, they take a high fee, so you might as well have paid the tax. And then the other thing is that you have to make sure that the DST that you're investing in, the corporate tenant, is solid, because if the tenant decides to move locations, they're still on the hook for this long-term lease. And so we try to find mission critical distribution centers or a medical building that's key to their fundamentals of their company. But if the parent company goes bankrupt, This is actually a safer investment than a bond, because on a bond, you're going to get 10 cents on the dollar. With this, you still own the real estate, and that's why it's key to making sure a DST sponsor is well financed. It may stop the cash flow in the worst case scenario, but the sponsor can re-tenant the property, and they'll have the ability to not lose the principal on their what they invested.
And I think that's the thing is we label all of these things. We just think that they're programs, but you're actually investing in a project. Like there's going to be better returns on some, not so much on others, but you're investing in a company that's going to be renting the building. You're investing in this project. And so it's a real thing.
It's a real thing, and that's why it qualifies under the 1031 code, because you actually own a piece of real estate.
So I guess the last thing I wanted to touch on is there's going to be a lot of people, a lot of generational wealth being transferred. People are looking into the future, just saying, all right, this is my portfolio. These are my kids. Sometimes they get along, sometimes they don't get along. Like there's a lot of dynamics that go into passing down generational wealth, generational properties, different things like that. So if somebody sells a property and it goes into a DST, and then if they unfortunately pass away, what are the tax implications of that?
So because it's real estate, they get the step up in basis like any other real estate transaction. So they do have to hold it until we sell it, and then they get the step up and they avoid the tax. We do have a unique program and a unique structure because Four Springs Capital has a REIT. It's currently private, but we're planning on taking it public. A DST investor could be in our DST for minimally 2 years, and sometime between year 2 and 5, we can offer them the option to move their investment in that one particular DST. Say they bought a piece of an Amazon. We can offer them, it's a secondary tax deferral. It's the tax code 721 UPREIT. And they can move their investment from that particular DST over into the REIT. And so once again, the REIT is like a mutual fund of the same type of portfolio. So why would somebody do that? They have further diversification. It minimizes the risk because their investments spread across the entire portfolio. But also what's beautiful about that is that they get liquidity. They'll have access to, say they did a $3 million transaction and they wanted access to a couple $100,000 a year. They could convert those tax protected shares, sell them in the open market, just pay the tax on that pro rata portion so they can piecemeal their tax burden out. And it's a really good estate planning tool because say they do have several heirs and they have different financial needs, they can act independent of each other, and they also get the step up in basis like any other real estate transaction.
So a step up in basis for some of us that may not know that, it's basically, they bought the property at a price, they've passed away on a certain date.
Right.
And it eliminates that.
It eliminates the capital gain.
And then, but if it appreciates from the time of death to when they sell it,
then they have to pay tax on that.
So, I mean, shoot, some of these properties have been owned for 30 years.
Right.
There's a little bit of a step.
Right. And there's a lot of investors that don't even know that a DST is available. I get this all the time. Like, I wish I knew this. I just sold something last year. That's why I always recommend just, talking to me before you even sell. I walk you through the entire program and, go through every pros and cons. And a lot of times investors will start maybe they'll start small, but then they're like, wait, this makes more sense for me because it fits into like my lifestyle and, I can go retire and not really have to worry about managing my portfolio. So we have to put a little
warning. It could be addictive.
Yes. That's what actually you should call it.
So I just did a video with Michelle. If you haven't watched that video on the 1031, Heather with the DST, you guys work together. You came out to our office.
Yeah, we're not in the same company, but I refer her business all the time because her and her team do an excellent job. I've worked with her for like 10 years and they do exchanges seamlessly.
So if somebody calls you and the DST isn't the right thing, but a 1031 might be a right thing, you've got somebody,
right,
and vice versa.
Right.
That's why we kind of talk to you guys together. And I like the fact that you recommend each other and you're not a part of each other's.
Right.
It's basically professional respect.
Yeah.
So if they have any questions, how do they find you?
You can reach me on my email, which is hahrens@fscap.net.
Or they could reach out and give you a call, give me a call. I can point you to either
right.
Heather or Michelle. But I really appreciate you watching. If you made it to this, you've watched quite a lot of information. There's a fire hose of information. So I'm sure there's questions after this video. So please reach out.
Thank you so much.
Yeah,
this is great.